Thank you so much for coming and welcome to the Financial Literacy Workshop Series hosted by the Cupertino Youth Activity Board. I'm Nelson.
And I'm Ellie.
And we are going to be your MCs this afternoon.
For this session, we'll be having an amazing panelist from the KeyPoint Credit Union who will be helping us understand credit. He will be focusing on the components used to determine a credit score and why credit matters. Then he will explain how to build good credit and how to protect your credit.
As a reminder, feel free to leave any questions you may have during the presentation in the Q&A chat. Our YAB members will be facilitating the chat and reading any questions you may have. And at the end of the presentation, there will be a 10-minute Q&A session for any questions you might have. And with that being said, let's go ahead and get started with our presentation. And I'd like to introduce Doron Neumann.
Great. Thank you very much. Thank you very much, Ellie and Nelson, for introducing me and for the Cupertino Youth Board for hosting this event. Let me share my screen. Okay. Great. My name is Doron Neumann, and I'm from KeyPoint Credit Union. And I've been with KeyPoint Credit Union actually this month 16 years. I've been in the banking industry for over 20 years. And this is something that we do a lot to my job as part of what the credit union does is we do a lot of financial literacy, financial education outreach, and it's very important component of what we do at the credit union. Last month, in October, we had the first session of the basic money management. And today we're going to talk about understanding credit, really understanding what is credit score, how is credit generated, and why does it matter to you, and what is your responsibility in establishing credit and protecting your credit. In January, we're going to have the last session about making good money decisions, talking about taking all the components for the first two sessions and putting it together, learning how to manage your money and what to really help you create strong foundation for a strong financial future. So there are a lot of questions about it. There's a lot of misunderstanding and actually a lot of knowledge go into what is credit. So today I'm going to go a little background, establish, if you were in the previous session, I covered a little bit about what is financial institution and why it's important. I'm going to cover it a little bit today because it's an important part of what is credit and why is credit established and so forth. So financial institution. A financial institution is an organization like a credit union, bank, or brokerage that licensed to take deposit and make loans and offer financial services. And they offer usually checking account, savings account, loan, investment services, and so forth. Usually, most of financial institutions in many countries are regulated by the government or the central bank of this country. Financial institutions are an important part of the economy because without them, people will not be able to get capital. Capital, I mean, they wouldn't be able to get assets or money to invest and grow the economy. So it's very important when people, what financial institutions do, they take money, they take the money as deposit, and then they lend it to other people, to businesses and other people, so they can actually buy homes, buy capital and buy industry to expand the economy. So some financial institutions that we have credit unions, we have retail banks, retail credit unions like KeyPoint Credit Union, there are technology credit union, Mary West, there are many credit unions, retail banks, Wells Fargo, Chase, Bank of America, those are considered retail banks. Commercial banks are usually service businesses like Comerica and some other banks that are Heritage Bank are only serving businesses and commercial enterprises. Investment banks usually do investment. Private banks usually cater to individual with very high network and so forth. And online banks you have, and central banks are usually banks that are managed by the country, some government, central government, or independent of the government, but they are regulating the financial institutions within that country. So very important to have financial institution within the country. In the United States, we have credit union banks, retail, commercial banks, investment bank, and so forth. So, and those banks or credit union, financial institution, they offer a number of accounts. One of them is deposit account that you can actually allow you to manage your money. You put the money in and you manage your money on a daily basis. Those are deposit account when you deposit your money. Deposit account usually have checking account, savings account, money market account, certificate of deposit. These are the things that we covered last time, but it's important. I want to make sure that I cover it a little bit so I understand how the system works. So when some people deposit money in the financial institution, in turn, the financial institution take this money and turn it into loans. A loan is an extension of credit to a consumer or business in a form of borrow funds, which need to pay back with interest. So what happened, the financial institution take the money you deposit and turn around and lend it to other people in terms of loans. And we're going to go some of the loans, what kind of loans we have. There are a lot of terminology when we talk about loans, and it's important before we go into credit because in order to understand credit, you understand the basics of loans because credit derives out of loans. So interest is a fee paid to the person who borrow money. When the money is deposited in interest-bearing account, interest paid to the person to deposit as a percentage of the amount of deposit. So what happened when you deposit money in financial institution and you deposit in a savings account, you receive back interest rate. Interest really, it's a fee for someone to use money. But when you borrow money from the financial institution, from the lender, you pay percentage amount, the fee to the lender. So interest is really the fee that you paid. If you deposit money, you get paid. If you borrow money, you have to pay back to the financial institution. Savings account, the financial institution pays you interest by using your funds. In this case, you are the depositor, meaning that you get paid the interest. On the other hand, if you borrow money in the loan account, you pay the financial institution interest for using their fund, and in case you're the borrower. So when you take a loan, you're the borrower. You borrow money from the financial institution. So here are a few terms on loans, and I want to make sure I'm not going to go, try not to go too fast. A lot of definitions, some of the things that I'll recommend for you. If you don't remember all these definitions, I will recommend for you to go into any website, a lot of websites, and you Google loan terms, and it will give you all this information about what are loan terms and so forth. So you give a definition to the terms. But so go first, principal. Principal is the amount that you borrow. So if I would like to take a loan for $1,000, my principal of the loan going to be $1,000. If I borrow $1 million, my principal is $1 million. Principal is the original amount of the loan. It's called principal. The next one, we have rate. Rate, so if we talk about interest rate, rate is really what the level of interest that you will get, you pay back. If let's say if you are borrowing money, what is going to be your rate? I mean, it can be like 1%. Usually in term, the rate is in terms of percentage. So it's 1%, 2%, 3%. So when you borrow money, the rates, the fee that you pay back is in terms of rate. If you hear, well, I took an auto loan and my rate was 3%, mean that the rate on the principal, the rates on the principal was 3% of the loan that you pay, 2% of the principal that you pay back as a fee. Time period. Time period is the length of the loan. So there be a loan that can be 5-year loan. There are loans that can be 30 years loan. What do you mean is a time period is how long, usually it's turned into, we talk about time period, we talk about month and years. So let's say if I say my loan is for terms of 12 months, is 1 year, means that I have to pay 12 months my loan back in the duration of 12 months. Payment is what you payment on a monthly basis, what you pay back on the loan. Fixed rate loan. So different kind of loans. There's loans that are fixed rate, mean that if I sign, I say that your loan, I take a loan now for $1,000 and your rate be 3% to the term of the loan, your rate's going to be 3% to the whole time of the loan. It will not change. It's a fixed rate, 3%. Excuse me. Variable rate. Variable rate is the rate that changes to the lifetime of the loan. So let's say some loans that every year the rates will go up. So it's a variable rate, meaning that the rates will go up every year. Depend on certain index, it might go down, but it usually goes up. But again, it's variable, I mean, it changes depend on the index where the loan is depend upon. Cosigner. So the loan, when you sign a loan, there's one person that's in charge of the loan. It's the primary person on the loan, but there's also cosigner. Sometimes either you cannot get the loan and you have to have someone to sign for you on the loan, or sometimes there are two people that sign on the loan. Cosigner, anyone that signed the loan is responsible for the loan. So cosigner, I mean a signer, someone that signed for the loan. A cosigner, there's another person that signed for the loan. So there two people, there's a signer and a co-signer, and those two people equally responsible for the loan. This is very important. I'm going to go on this later during our presentation. Simple interest loan is a loan that actually you pay interest only on the principal. So whatever the principal is, this is what you pay interest on. So as long as they say that the principal go down, if you took $1,000 loan and you paid, the first payment was on $1,000, but you paid $80 now. The next time your interest not going to be on $1,000, it's going to be on $920 because it takes down the payment, whatever the principal will be. And this is about approximate. So it's whatever the principal deduction out of the amount of the loan. This is what you pay interest on. It's called simple interest loan. On the other hand, you have a compounded interest loan and you pay interest on interest. So you usually pay more interest on a compound interest loan than a simple interest loan. I'm not going to go into much into it because it can be a little bit more complicated, but I just wanted to know some of the terms and something that you maybe want to look at it later into simple interest and compound interest loan. Payoff is when you pay off the loan. I mean, you can pay off, your loan is for 5 years and you pay 60 months and you pay every month, you pay it well, and the loan balance is zero now. You pay off your loan, or you just decided that after a year you want to pay it off, you have some cash, you go to the financial institution, you pay off the loan. The loan is paid off, meaning you finish your obligation for the loan, you pay it off, and you return the money to the financial institution. Collection is when you don't pay off the loan and you're late. What we mean that, let's say you pay on a monthly basis, and after 30 days, your first payment you did not pay, and after 60 days you don't pay, and it's 90 days, usually the financial institution send it to collection. There's a company, the financial institution has a collection department or send it to independent collection, and they come to collect the fee for you. They will call you and try to collect the fee for you, the loan amount. And usually there are fees and there are penalties that on the loan. So you never want to be late on a loan. Charge off is when you don't unable to pay off the loan, and the bank or the credit union will have to write off your loan, meaning that they know it's total loss. We're not going to get back the loan from you, and they have to charge it off. Repossession is when you buy and you have a car and you have an auto loan and you don't pay the loan, the financial institution will come and take the car from you. Because remember, when you buy, and we'll go a little bit in a few minutes into it, it's when someone come and take an asset from you. It's repossession usually on a car, a motorcycle. Foreclosure is when you don't pay your mortgage, and we're going in a minute, and the financial institution can sell your home because you don't owe it, because you have a loan on it. So foreclosure is for home. Repossession usually is for cars or motorcycles. So type of secure loans, personal loan. So a secure personal loan is a loan backed by collateral, meaning that you have something against it, that I give you a loan for $1,000 and there's something against it. So the first example is home loan. A mortgage, usually a home loan calls mortgage, and you have a loan against the home. So what happened if you don't pay the loan, the financial institution can come and sell the home for you and recoup the investment, the money back, the loan back, the value of the loan back by selling the home. Usually people say, well, it's my home or it's my car. In a car loan, it's the collateral is a car, but really when you take a loan, the car or the home is owned by you and the financial institution. When you pay it off, then it's called you you clear a clear title or a clear deed of trust, I mean, you own this without any loan on it. But as long as the bank or the credit union has a loan on it, they have interest in the asset, in the home or the car. Motorcycle loan is a secure loan. RV loan, those are some examples. Stock secure loan, if you're a stock and you can take against a loan against it, it's a secure loan. It's something that you can, if you don't pay it off, we can come and take this against the loan. And certificate of deposit, secure loan, your money in your financial institution, and you cannot touch this money until you pay off the loan. Or there's some different way of doing it, but mostly this is against the deposit. The funds are in the certificate of deposit are against the loan, the backup the loan. So type of unsecured personal loan. So unsecured personal loans is offer a loan without collateral. You are guaranteed. So I mean that there's no collateral. You is the one to guarantee for the loan. So student loan, if you take a student loan, you guarantee that you will pay it back to the financial institution. You're the guarantee. It's not secure. It's by your guarantee. Personal loan, you take a personal loan, you guarantee that you pay. There's no collateral. The bank will not come and take you. It's a personal guarantee that you say, I agree to pay this loan back and pay it back to the financial institution. And personal line of credit is the same thing. There's no guarantee. I mean, that it's your guarantee. There's no asset against it. So the type of loan. So what is a credit card? You think credit card is a secured loan or unsecured loan? So credit card, it's an unsecured loan because credit card, when you use a credit card, you don't use your own money, you use the financial institution money, but there's no guarantee behind it. Even let's say you go buy a TV or clothing, the financial institution will not come and take your clothing and TV or your food from you. You guarantee that you will pay it back. So credit card, it's an unsecured loan. You pay it back. It's not your money that you use, and you have to pay it back to the financial institution. So now that we talk about a little bit what are loans, what kind of type of loans we have, some of terminology about the loans, I want to go into credit. What is credit? Why is credit established and so forth? The really credit were established just because of loans. So I'm going to put a disclaimer, and so this is really for educational purpose only. And usually, the reason I put it is the people that are older than 18, then I cannot discuss their specific credit. And the purpose of this presentation to help you better understand credit reporting. Cannot discuss specific issue to personal credit report. I cannot advise anyone about how to improve the specific credit score. Cannot submit dispute regarding your personal credit report on your behalf. So this is a little bit disclaimer. What we do here is more educational. It's not about discussing someone's specific credit, really understanding what overall is credit. So what is credit report? So I'm going to give you a few scenarios. Scenario one, you go with your friend to the store and you buy something and your friend buys something and your friend forget their wallet and they say, oh, I forgot my wallet. Can you lend me $10? I will promise to give you back next week. So you give him $10 and next week come in and your friend come back and pay you the $10. So this is scenario one. Scenario two, you go to the store with your friend and the same friend, and your friend say, oh, can you borrow $10 from me? I forgot my wallet, and I'll pay you for a week. In a week time, I promise to pay you back. And you say, yeah, he's my friend. And you give him $10. 1 week pass and your friend did not give you $10. You meet him again and you say, oh, what about my $10? And you say, well, I don't have money now. I give you next week. You meet him next week and your friend did not give you your money. Scenario number three. Now you go into the store and there are three friends. And remember, scenario number one, when you give your friends your money and he gave you back. Scenario number three, you go with the same friend and a new friend into the store. And this time the friend that borrowed money from you asks the other friend, hey, I don't have money with me. I forgot my wallet. Can you give me $10? Your friend knows that you lend money to the other friend and he come and ask you, did he pay you back? And you say, yeah, of course, you pay me back, no problem. You can give him $10. So now you were the reference, right? You say, okay, yeah, no problem. He gave you back. He kept his word and he paid me back. So the other friends gave him $10. It's not a problem. There was a reference there, and he gave him money. Scenario number 4, relate to scenario number 2. You go with the same friend and another friend to the store, and then the friend that borrowed the $10 from you and never gave you back the $10 suddenly ask the other friends to give him $10. The other friends know that you lend this friend $10, and he come and ask you, did he ever pay you back? And you say, no, he never paid me back. Most likely the other friend will not give $10 to the friend that did not pay you back, because you were the reference. You told them that they did not pay back. So in overall, this is how the credit works. Credit report. Credit report is really a reference. And so a credit report is your financial report card with information that determine your ability to repay, borrow money, and your financial credibility. This is all credit report. So it's about, did you pay money back when you borrow money? And this information is recorded. This information is used to assess your ability to purchase goods and services and pay them over time. So really it's about someone give you reference about, can you borrow money and pay it back over time? Determine your financial trustworthiness. I mean, that someone can trust you to give you the money because you're going to pay them back. And your personal credit report includes record of all your financial account and obligation, and your identification information associated with them. So your report, it's a report card. It's really a report card about how you do with your finance. Do you pay your loans? Do you owe money to anyone? How do you pay it back? Your personal information, where you work, where you live. All this information is put into one report, and this is your personal credit report. The report sometimes called credit file or credit history. Some people say, hey, would you have your credit file or your credit history? It's about this report that have all the information, your information, financial information. It's one information to ID you. It's a social security, where you live, where you work, and so forth. And those information is collected by number of companies, and they're called credit bureaus, and they collect all your credit information, credit history, and all your information from public records. So if you have any public record, they collect it and put it in your credit report. Credit report, a record of debt paying history. That is loan, any loan that you take, it's a record of it, how you pay it, and did you pay it well, you didn't pay it well. So they're looking at car loans, student loans, credit card, department store credit card, mortgage, motorcycle loan. Any loan that you take is recorded on this credit report. And I'll show you how it's recorded as well. Include how much money you've borrowed. So this credit will say how much money. Let's say I took a loan for $1,000. It will say that the loan amount extended, what the credit extended for me, was $1,000. Who you borrowed the money from, how your timely payment were. I mean, did you pay it every month? Were you late? And how much credit is available? And the credit record that we sometimes call the credit score. Excuse me. So everything that has to do with your loan, if you pay on time, sometimes you'd say you didn't pay your payment, the agreement on a loan that you pay every month on the 5th of the month. And let's say that you pay on the 20th of the month. Now you're late on your payment. It will show as a late on your account. It will say 30 days late or 60 days late or 90 days late, and it will affect your credit rating or your credit score. So in the US, there are a number of credit bureaus. The most permanent credit bureaus that collect your information from you, and I will go in a minute, are Experian, Equifax, and TransUnion. Those are the main credit bureau, and they all collect your information, and they get information and that you have in the past. that you applying for. And what they do is they collect the information, they sell this information to financial institution. So remember I talked about scenario 1 and scenario 2. So what happened, the credit report is, it's in the effect of scenario 3 and 4, they're the reference. So let's say you borrow your friend, you send the information and say, yeah, he paid me back the information, the money, everything is recorded. And what happened is when you need a reference about someone, when they apply for a loan, you go into their credit report, you go into Experience or Equifax or TransUnion, depending on what your company is using, and you ask for the credit report for this person. You send a request and you receive the credit report. And this credit report is your scorecard of everything that you did. And based upon it, the financial institution will determine if to give you money or not to give you money. It's the reference that financial institution use in order to give you funds or not to give you funds. So there are three major credit bureaus. And those are the credit bureaus. And at the end of the presentation, I'm going to have the website for each of those, and a lot of information on those credit union website that you can look at. You don't have to go any other place. They have very good resource there about credit and loans and so forth. So really, what is the credit cycle? So credit cycle is you take a loan, and every month you pay back to the lender. Lender is the financial institution, the institution that lends you the money. The lender sends this information to the credit bureaus. So they take your information, and the credit bureaus update your information on a monthly basis. So if we sell a file with all the information of all our members to the credit reporting agency, to one of the Experience or TransUnion, they take this information and they record each person, how did you pay your loan that month. Now they take all this record, and what happened, they share this record, lenders share this information with the lending companies, and now the credit reporting companies share this with new lenders. So let's say when I need to lend you money, I go to the credit bureau, and I have to be a member of the credit bureau, and I say I'm looking to apply. This gentleman apply for, or lady apply for the loan. I would like to see their credit report, and I send them the information, and they send me their credit report. And so I can review it and make a determination, should I give you a loan or not? So what is credit score? Credit score, the number of way of to score it. So the different models that if different companies, different models to score your credit. Usually the credit score ranges between 300 and 850, which 850 or 900 is the highest, and the 300 is lowest. Most credit unions, including the FICO. So people say, well, my FICO score, you hear FICO. FICO was the first company, it's called Fair Isaac Corporation, was the first company to put this model out where they can calculate your credit score. It's usually each company's proprietary formula, so people didn't know exactly how the formula works, but there's a general idea that they give you what to do and how does it calculate this information. There's so many components that go into your score. So excellent credit, if you have excellent credit, usually ranges between 850 and 781. Good credit, 661 to 780. Fair credit is 601 to 660. Poor credit is 501 to 600. And bad credit is below 500. So why this is important? First of all, it's important. Let's say I'll get someone that have excellent credit, and I would like to give them money, and they come in board, they say, I would like to get a car loan, auto loan. I will definitely provide them with auto loan. Of course, you have to, we look at different things, but one of them is a credit score. When you look at auto loan, you can look also if they qualify, if they have income, if they have other things. But let's say just basis right now on credit score, what it tells us that this person is paying their loans on time, they're very good, excellent credit, and we will provide them with credit. We'll give them a loan. Usually, a rates of the loan, what the fee that you pay related to your credit. So let's say that the financial institution, you said the best, if you have great credit, I will give you your rates your fee on your loan going to be 3%. Okay, so if you have 781 to 850, you will get 3%. Of course, you meet all the other criteria. But let's say you have a credit that is below 500. Usually, most financial institution will not give you a loan, because what it tells them, you took loans before, you never paid them back. Why should I give you a loan? But let's say you have fair credit and decided to give you a loan. So if the best rate that you will receive, if you have excellent credit, 3%, you may receive, this is just really example, you may receive a rate of 5% or 6%. So the lower your credit score, the higher amount you pay, because there's more risk in it. So when there's more risk in it, then your higher fee that you pay back to the financial institution. They're assuming more risk to lend you funds. So here you see how the credit score ranges. If you have excellent credit, you qualify for the best interest rate, usually qualify for best interest rate. If you have a very good credit, and when you have above average, you may face slightly higher interest rate, and then go to when you have worse credit under 500, facing extreme credit issue, usually you will not be able to receive any qualify for any loan. So really always want to make sure that you want to have, like in school, you want to have an A, you don't want to have an F. So always you want to make sure that you aspire to have the best credit. Now we'll go over what really makes best credit and how can you reach good credit. So this is the model that will show you a little bit what the credit is made out of, and it's created by the Fair Isaac Corporation, which is the name of the corporation. And so those are the component, the overall component, what goes into the credit. So if you look here, the first 35% is a payment history. Payment history is really about how did you pay your past credit account, mean your loans. Did you pay it well? Were you late on your loans? Were you on time when you pay them? You paid off when the credit was the loan, you paid off well, or you just were late. Sometimes you paid, sometimes you didn't pay it. So really a big part of it is about payment, when you pay on time. Amount owed, it's about 30%, is how much you owe to the bank or the credit union, and how much credit is available for you, how much do you use, how much you utilize. So let's say that if you have a credit card and the credit card limit is 20,000, and you only use 3,000 out of it. So you see that actually utilize the credit well. But if your limit is 20,000 and you maximize your limit, then you owe 20,000 on it, your score probably be affected because you utilize everything. Means that people know that you're unable. The assumption is that you have some financial difficulties. Sometimes people charge it right away and pay it right away. It's not a problem. But usually if it's turned into like you keep the full balance on the credit card, means that you have some financial difficulties, and usually it goes into the equation and it's lower your score. So it's how much you utilize it. Also, if people, you have a credit card 20,000 or 10,000 and you go over your limit, credit card limit, then it hurts your credit because you actually went over what credit was extended to you. 15% of it is the length of credit history. How long you have a record of the credit. So if you're like 18 years old, most of it, credit will start when you're 18 years old. There's no credit report before you're 18 years old, because usually you personally cannot sign on a loan. You can be on a authorized signer on a loan, but if you go yourself before you're 18, usually you do not receive a loan, so there's no credit history there. But if you let's say you're 18, you don't have anything, you can start slowly building your credit. I'm going to talk about in a few minutes. But 15% of it, if you have 10 years credit and you pay it well, then you get higher score. And type of credit use, what is the mix of credit you use? If you have student loan, if you have mortgage, if you have auto loan or credit card, it's what it's called a credit card called revolving credit, mean that you as you pay the credit, you can use it. Let's say you have a credit card and you charge $1,000, then now you have less credit available for you, but you pay off the $1,000. Now you have the full extended credit. It's a revolving credit. As more you pay it, more you can use it, close to the balance. Fixed loan, excuse me. Fixed loan is a loan that you pay. There's no revolving. You have to pay it all the way down, like an auto loan or a mortgage. And 10%, the last 10%, it's new credit. How much of your available credit is new? When did you take your credit test? When you take a loan last? So if we see that someone is applying for many, many loans and you have a lot of loans recently, their credit probably going to go down because it's mean that they need some money. So your credit is going to go down, or maybe you didn't use your credit for 10 years and suddenly you apply for a loan. So it's really looking at how new is your credit. So this is some of the components that go into the credit. It's a little bit more complicated than this because they put a lot of other factors in it, but this is just overall give you an idea what are the main components of how credit score is built. This is a sample of a credit report. So it gives you the name of the person, and this is just a sample. So the name of a person, also give you their social security, the date of birth. It give you any potential negative item. So it give you if they have collection, if they have any lien or anything on the credit public record, it will give you public record. And then here it will give you a credit item. So let's say if they have a credit card, what is the amount of the account number, what is the limit of the account, what is the payment, the current balance, all the information about the loan, how did you pay the loan history, everything going to be, and it's going to be a number of pages that will have all the credit items. So this just give you a sample of like what credit, from experience, what the credit report looks like. And it will have the score, you will have the score up here, and it will have all the information in the credit report. I mean, if you have a chance and, if one of your parents want to share with you the credit report, they have it, and they can go over it and it can show you what the credit report looks like. And I'll give you some information about it as well in a minute. So why good credit matters? Good credit matters because it affects everything in your life. Housing, you can't really get a home if you don't have credit. You can get mortgage, but you also cannot get rents because you rent a place because they look at your credit. So if you don't have good credit, you can rent a place, you can buy a home. Transportation, if you don't have good credit, you cannot buy a car or a motorcycle because no one's going to give you a loan for it. Employment, some companies run your credit report to see how you do, how responsible you are, especially if you work for a financial institution or any other government agencies. They will run your credit report to make sure that you are responsible, and especially when you deal with money, make sure that there's no any issue with the credit report. Utility services, many utility services as well as cell phone services will run your credit in order to give you a cell phone or electricity and so forth. Insurance companies will run your credit to see how you do, and then if you have bad credit, you may not be able to get insurance. And entrepreneurship, if you have a business and you want to borrow money to a business and you don't have good credit, then you can really borrow money for your business. So you have good credit, you can borrow money for your business. So this really affects your credit. Good credit really matters because it can affect many things in your life. How do I build good credit? So really, the first rule is understand what credit is. So I recommend for you to go to the credit bureaus and really learn about credit. What is credit and how do I utilize it? Don't do anything. Don't take any credit, any sign for any loan before you understand what is credit and what are your responsibilities. Do not sign anything unless you understand what are you signing for. So really never sign for anything unless you understand what you're signing for. And it's very, very important. Do not be a cosigner. Some of the things that we see is that people, someone needs a credit and someone say, oh, I can cosign for you. Every time you sign on the loan, you're responsible on the loan for the loan. So let's say you sign for someone and they did not pay the loan, it will affect your credit too. So every time you're on the loan, regardless if people say, well, you just co-sign, you're not responsible. Every time you sign a loan, you're responsible. So if the person that you signed for helped them to get the loan, did not pay the loan, your credit affected by it. So it's very, very important. You never sign anything unless you understand. Be responsible. Always pay on time. Be responsible. Don't take anything unless you can pay it back. Make sure you can pay it back. Always, always. Make sure if you take a loan, pay it on time and pay it back. If you don't have an ability to pay it, don't take a loan. Charge only what you can afford to pay. Uh, Again, don't take a loan, and if you cannot pay for it, only to buy, and only when you buy something you can afford. So don't go tomorrow and charge something for $1,000 and say, oh, I'm going to pay it later, and you're unable to pay it, because it will affect your credit. Everything is recorded in your credit. Pay all your loan and credit card bills on time. Always, always. The first rule is always pay on time if you take a credit. Avoid going over your credit limit on your credit card account. If you have a credit card, do not go on the limit. It will affect your scoring dramatically if you go over your credit limit. So I will suggest, do not sign for anything unless you understand what you're signing for. Okay, it's very, very important. Make sure you understand. Make sure you talk with adult. Do not sign it. Even when you turn 18 and you have the offers, make sure you talk with someone and you know what you're signing for. Don't sign for it. If you take something from today's, make sure that you're being responsible and you don't sign for anything that you don't understand what you're signing for. Know which account are shown on your credit report. So you can have your credit report once a year, and you can have it for free from those credit companies, and you can have it once a year free credit report. So it's very important to get once a year credit reports from them and review information. Make sure your address is correct, your name is spelled correct, your social security is spelled correct. And many times people steal credit and apply under your name. So make sure there's no any fraud, there's no any information that any credit cards or any loans that are not on your name. Sometimes people steal information and apply in your name. So make sure that everything is on a credit report is yours as incorrect. Check that information shown in your report is accurate. Always make sure that it's accurate. And create a budget. And we will talk about the next time is about creating a budget. What is a budget, and why do we need to create a budget, and how budget really meet credit score and so forth, why it's important to have a budget, how you spend and what you spend and so forth. So if you take everything from this, I want to make sure that you understand is that the credit is your file, and the records stay on your file for a long time. So anything you do now will affect, even let's say you go to college and you decide, oh, someone come in and they offer you a credit card and you don't understand anything, you just sign for it and you charge what some of the things we see. Students go to college, they charge on the credit card, they have a first-time credit card, they charge, and they don't think they have to pay it back. And so when they end college, when they finish college, suddenly their credit report is at 500, 300, because they never paid, they already have delinquency, they charge off the credit. So make sure that always, if you take a credit, to get your information to your the address is correct. But also, if you take credit, the best thing to do is always set up automatic pay from your account, so you never forget it. So always automatic payment that go from your checking account into your credit, your loan account, so you never forget, you never miss a payment. This is very, very important. So there's a credit report, and the federal law allow you to get free credit report every 12 months from each credit reporting company. Ensure that all information in your credit report is correct, up to date. So if you want to take a minute and write this information, it'd be great. Some companies sell you credit reports. You don't have to buy credit reports. You can get your credit from those companies. Now, if you have a credit and you have issues with the credit, you can dispute it. There's some laws about it. You can dispute your credit, and you can contact the agency, the Equifax, Experience, TransUnion, and you can dispute it. And there's a whole process of dispute, and they can help you with this. They can help you with correct any dispute you have, any fraud, or anything that you have any credit that's not yours. They can help you with it. Or even if you have something that you think it's not right, you can dispute it, and by law they have to answer you and help you to correct it. So there's to give you information, Equifax.com, Experience, and TransUnion, and this will give you a lot of information, free information. We went over this pretty quickly, just to give you an idea what is credit reports, how do you manage your credit, why it's important to have credit, and a little bit idea of really credit is driven from borrowing money. When you borrow money, you know that it's all recorded, and you supposed to pay it back. So this is what I have for today. Of course, it's a much longer. If we go into details, we only had 50 minutes to it. So if you have any questions, I'm happy to answer them. Thank you very much first for joining us today. And if you have any questions, we do have a branch in Cupertino. You can always go there and ask our branch manager or management there, or any financial representative about anything, and they'll be able to answer your questions. Okay, I'm ready for questions.
Okay, Doran, thank you for that presentation. Sadik and I will be reading off the questions. So we have a few in the chat right now. And if any of the people participants here have any questions, you can go ahead and click on that Q&A button and just type them in. So let's begin with the first one. As a student, what do you think is the most important thing we need to be careful of when money managing?
So when a student and right now, okay, so when you manage your money, you don't, the first rule for me is about saving. You want to make sure that you save enough money. You always enough savings. Okay, you spend less, you save more. When you go to college and you decided, okay, I'm going to take a credit card, I need a loan, you need to be very responsible and learn what are you signing for? Never sign for something that you don't know. Someone can come and say, oh, I have a t-shirt for you, just sign here and you get a credit and get all excited. People go to department stores and they say, oh, you give you $10 now and you can save 50% on the purchase. And people sign for it and it will give you credit. And then the credit, like for most department stores, I can see some students do it. They go to a department store, they get credit, they receive 30% off of the purchase, they're all happy, but they have to pay it back, and they never pay it back, they ruin the credit. And the rates on those credit cards are usually on 20-30%. So you pay a lot for the saving 30%. So don't sign anything on the spot. Take it to adult, make sure that you understand what it is. When you get to 18, you want to start establishing your credit. The best way I can tell you, the way I established my credit is when I was younger. So I took a loan that was secured by certificate of deposit, $1,000 loan that was secured by certificate of deposit, and I put it in an account. And this money, I did not touch this money. What I did every month is I paid back into the loan. So what happened when I finished the loan, I had very good credit. I mean, I started establishing good credit because I paid on a monthly basis, but I still have $1,000 saved. So you do a secure loan, and you do everything that I did. I'm going to make sure that I do it. I always pay on time and understand what I'm signing for. Never sign for, I'm talking about if you go to college, never sign. We see some people sign, oh, this is my best friend, I signed for him. And if your best friend doesn't pay, guess what happened? Because you're in the loan, the financial institution will come after you. So the big thing is being responsible. Save as much as you want. I mean, as much as you can. Don't spend much and be responsible. Yep.
Thank you so much for that. And we have another question here asking, how can teens pay back loans on time?
Okay. Well, first of all, you have to have income to pay a loan on time, right? If you don't have income, you wouldn't get a loan. The financial institution will not give you a loan unless you have income and you can prove that you have income. So when you start showing that you have income, then you will receive a loan. But until then, you will not receive a loan. When you take a loan, what I recommend is to do automatic payment from a checking account or savings account that you have money in into your loan, so you never miss a payment. And then you don't have to worry about it. Also, one thing that I always do, I still do it every day, is today you have your mobile banking. You just always check your bank account, your credit union account, your checking account, saving. You always check it and say it only takes 5 minutes, and you check to see, okay, how is my financing stand on that day, and make sure always that you pay it back. Yeah. Any other
Okay.
question?
Yep. Do you have any advice on college loans?
Well, college loans, so student loan, we talk about student loans. So I can give you advice on what is a student loan. When you take a student loan, you, of course, you have to pay it back. So let's say you start a student loan, when you start your college, you have to pay it back. Student loans, you have to start paying back student loan 6 months after you finish school. What I mean finish school. So let's say if you sign for 4-year college, and after 2 years you decide, oh, college is not for me, I don't want to stay. I'm done with college. 6 months after this, your student loan starts. It's not start 4 years after after your 4 years done. It starts 6 months after you done with college. So you take a loan, you have to start paying it 6 months after it. College student loans never go away. What I mean is that even people sometimes go into bad times and go into bankruptcy, and student loans, because it's backed by the government, student loan always stay there, and you have to pay them. So no one will forgive you on a student loan. So, I took some student loan to help me to go to college, and it's not a bad thing. But one thing you want to make sure that when you're done with college, you also want to look at refinance a student loan, depending on what your interest rate on your student loan. If you get a job and you get a good paying job, you want to start looking at this, and there's maybe ability to repay your student loan and lower interest rate. Yeah. But it's always always report to your credit. You want always pay it well, because it's always a report on your credit. Okay.
Thank you so much for that. And we have another question here. What percentage of your paycheck do you recommend to save per month?
Depend how old you are. So I mean, if you make money now and everything was provided for you, so I have 2 teenagers. Okay, I have 2 boys, both in college. Both in, college. One going to college next year, is senior, and one is in as a sophomore in high school. So they, when they make a little bit money, I tell them put 90% of it back in saving. 10% take, spend if you need some things, but I will say the majority of it go back into saving. You want to save as much as you can. When let's say you graduate from school and you have expenses, and you have to rent, you have all this stuff. I will say, first of all, if you get a job, you always want to enroll in the 401k program, and maximize how much you can to put in the 401k, because usually most companies will match some percentage of your contribution to the 401k. 401k is a retirement account, so you can put into it. But I will say, if you can, and let's say you have expenses, and you out of college and you have expenses, you have rents and so forth, I will try to save between 10 to 15% of my pay every month. But when you don't have the expenses and you pay, I will say save 90%, even 100% if you don't need to spend on anything.
Okay, we'll take one last question. Do you have any tips for how teens can balance college, example, paying for textbooks, food, housing, etc., and building good credit?
So, I'm sorry, do you have any tips of how teens can balance college, paying for textbook, food, housing, and build credit? Well, there are a lot of factors there. I mean, one of them is, when you go to college, do you work extra? I mean, do you go to college and you also have a job that you make money? There's scholarships. One thing is, I will say there's scholarships, a lot of scholarships out there. Okay. So we have a scholarship we're offering every year. Other financial institutions and other companies offer scholarships. It's a great way. I mean, it doesn't take much. I mean, yeah, it takes a little bit. You have to write an SMAB and send your transcript, but I mean, it's an opportunity to make money or to pay for college, to help pay for college. So I would say, look at scholarships. If you can work, then I would say make sure that you save some money, you pay for taxes, so forth. Sometimes you work in college is hard. Sometimes you work and you have nothing money left, right? So as far as credit, I will not apply for credit unless you really need it. Let's say if you, as I mentioned, I started with a secure loan against some funds that I had that I saved, and I was building my credit to a secure loan. And then I took a credit card, and I was very responsible for it. I mean, with it, when toward the end of college, I took credit card, and I was very responsible. Sometimes some parents will have their kids on the credit card with them, help them to build credit. But what happens is if you miss your payment, your parents' credit will go bad. So you need to make sure that you make the right decision. But as far as what you do, how to build a credit, again, there's different ways to build it. I will say, don't take just credit card and spend the money and don't pay it back. If you take something small, you have the emergency, and if you spend on it, pay it back. So there's a record that you pay it on time. Yeah. Any other question?
That is all the time we have, unfortunately. So I'm going to hand it off to Ellie and Nelson for closing remarks.
Okay. Thank you very much.
Yeah, thank you for answering those questions. I think that was most of them. So we're just going to go ahead and close off today's session. Thank you so much for coming to our part 2 of our 3-part teen financial literacy workshop series. Thank you so much for joining us this afternoon, and we hope that you found it informational. We'd like to thank our wonderful panelist for his presentation and for helping us students out during these unprecedented times. And we hope to see you guys for our next session, which is going to be focused on making good money decisions.
Yeah.
So
Thank you very much, everyone. Appreciate it. Thank you.